Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited today to be here with Thomas Griswold, the Managing Director of ALM First Financial Advisors Services. Thomas, how are you doing today?
Yeah, doing well, Mark. How are you?
I'm doing great. I'm excited to have this opportunity to chat with you. We've been in some joint calls in the industry before this, and I've always appreciated what ALM First can do for credit unions. And there's interesting things that have happened in credit unions in all of the things I think probably that ALM First touches here over the last few years. But if there's a listener who may not be, there's not a lot of credit unions that haven't heard the name ALM First. But if you want to maybe do a little primer on what ALM First is before we jump into some questions about the trends in the industry, et cetera.
Yeah, absolutely. So again, ALM First, we've been around this is our 30-year anniversary. So officially been in the institution for 30 years, predominantly in the credit union space. I'd say 95% plus of the work we do is within the credit union industry. It's something we really hold on to and we really love. As far as what we do, we've grown a lot in those 30 years. So started out as ALM reporting, interest rate risk management, and investment management, and grown significantly since then. And, we have a number of subsidiaries, but if I could maybe simplify our approach, we want to help institutions manage capital and generate returns in a risk-adjusted framework, with the ALM piece being center. So we'll always like to understand, what is your asset mix? What is your liability mix? And how can we ensure that we're keeping a balanced balance sheet? But outside of that capital allocation piece, which again includes the investment portfolio, we have a loan transaction network that helps put buyers and sellers together in the loan participation world. We advise on securitizations. We help in derivative hedging and mortgage pipeline hedging. But we also have M&A advisory, as well as the DDJ Myers team that focuses on talent management, talent acquisition as a part of our team, and has been for a couple of years. Yeah, I'd say it's a mouthful. We do so much. I mean, part of our focus is really, how do we help credit unions just navigate these very turbulent waters, for sure.
Got it. And as you describe that in the capital allocation and managing capital as the hub, I'm picturing a bike wheel, right? That's in the middle, and all those other things relate back to that. And the other thing that pops into my head is cash is king, capital's king, right? Because if you got great capital, you can survive a lot of things. You can survive a lot of trends, and it is king, right? So I guess that might be why it's at the hub of the way you've just described it. But it has been interesting times. We had, in my mind, having been an examiner, having been at NCUA, I always relied on the experts on the ALM, because there's nuances there, there's assumptions there. NCUA getting the capital market specialists and building that out it's a great resource and a great topic, but it was always one that was nebulous to me. And I've described that and liquidity and different things as like oxygen, that you have to breathe, but you don't think about it. But then when it starts to put you in a corner and you can't breathe, you realize it. And when you have liquidity and ALM type things, you realize it. And then it's, wow, this is super important. And you think about the pandemic, you think about that, the journey we went through there with money coming in, and then what credit unions decided or not decide to do with that. And then the Fed drops the huge rate increases on credit unions, which created an interesting environment in every area, but related to NEV, related to liquidity, et cetera, et cetera. So that's my 10,000 foot level of the recent history and where we're at. And there's a lot more to it, but in light of all that, what is it? Let's talk trends since then. Let's talk trends if you want to link back to the things I just said, but general thoughts on where the industry's at today, where it's been, and where it's going trend-wise.
No, absolutely. And yeah, I think feels like we've probably fallen asleep a little bit prior to 2022. We were in a zero rate environment for so long that, to your point, we forgot that all of this was important and it was intertwined. ALM, liquidity, credit, it's all linked. And we all know that we've seen such a significant rate increase. Now we're possibly going into a new rate regime with some recent Fed cuts. Remarks about, or are there cuts in the future? Are there not? Not one to speculate on rates themselves, but it's definitely made fixed income interesting again. We're in this period where we're just sleepy because we didn't have to worry about interest rate risk. And in that extended quantitative easing, there was also no real credit risk to speak of. And I'd say, given that, the recent trends that we've been observing that I think are going to impact a lot of institutions are, one, consumer loan growth has been fairly, I'm going to say, anemic the last few quarters. And that's something that, again, directly hits all credit unions. And what that has led to is in my opinion, it's made balance sheets start to look and feel a little bit more liquid. And that's something credit unions haven't seen or experienced in a couple of years. When rates started increasing, there's a little bit of a lag, but very quickly, credit unions started to see those non-maturity deposits that we had held on to and were such a big part of our funding base. We started seeing those outflows. Now, a lot of it was just moving into CD books, but that's not something we had really seen across the industry in a fairly good amount of time. And so we saw margins compress. We saw everyone just fighting for every deposit they can get. And it feels as though that's normalized. Rate shoppers have shopped, but the liquidity piece to me is less about all this deposit growth coming back and more, it's about the loan growth being a little bit slower. And so we're starting to see a little bit of cash come back on balance sheets. And my big concern, if I look forward into the future and play this trend out, is when we see institutions that don't have the loan growth they typically want, they start trying to force demand that's not there. And the way we historically have done that is drop rates to just try and create that demand. And one thing we're talking about is, if the demand's not there, the demand's not there. We can't throw risk out the window and let rates rule the day. We still have to make sure we're pricing our risk. So those are one of the big high level themes that we've been seeing the last few quarters. And again, not that we have a crystal ball, something that we see as storm clouds on the horizon that we just want to make sure we're preaching to still price risk appropriately.
And pricing the risk. And then also the other lever is the quality of the loan, right? It's like you can go into a meeting saying, hey, our profits are tight because we're not getting the loans out. Let's flip back through those last 100 loans we denied and see if there's anything we should tweak. And you know what? Maybe there is. I used to, when I was an examiner and I went to a credit union that had commercial loans, which were more complex, I would always ask to see some loans that they denied just so I could get a flavor for what I could see what they thought was good, but I wanted to see if I can see what was bad. And sometimes that can be helpful. You can learn from it, but it also can be turning up the risk in a way that doesn't keep the capital focused on the center of that wheel. Because if you take too much risk short term, you might be okay, but longer term, especially if the economy goes the wrong way, you could really find yourselves in a tough spot. Any thoughts on that side of it?
Yeah, you're spot on. If you're not pricing risk well, and on the risk side, it's not just duration or interest rate risk, but it's the credit piece, the liquidity piece. If you misprice that, you don't see it tomorrow. It's not that the next day you understand which of those loans were priced well or not. You see it 6, 12 months, 18 months down the road. And that's the hard part, is the lag that you completely miss. And when you're not expecting it is whenever you're getting hit, usually from multiple sides.
Right. Yeah, exactly.
Yeah, and it goes straight to capital. And you get, like I said, capital is the lifeblood. And for misallocating that or mismanaging it, that's what really leads to problems.
And what type of trends are you seeing then on the profitability side? Is the pressure super intense, situational? Is everybody feeling it? What are you seeing in that arena in light of these other trends?
Yeah, great question. I do feel that it's maybe we're able to catch our breath a little bit. We've seen delinquencies, at least the rate of delinquencies, start to plateau. It feels, and I think some of just the lack of fighting for deposits has allowed margins to catch a little bit of breath, because we haven't seen as many of the CD promos that are usually being launched to try and capture funding wherever you can get it. So it seems as though the last quarter or two, we've been able to catch our breath a little bit. It's more for me of, let's not be complacent. Let's catch our breath, make sure we can get our feet a little stable, but just be mindful of where we are in the future. But again, I think the shining light is we haven't seen as many of those, the CD promos, the really short 6, 11, 12-month promotional rates. Nothing against them. At the end of the day, to me, it's not about your funding costs. That's only one piece of it. It's about how you can line up funding costs and the rate you're getting on the asset side. Again, it's this dynamic. If we're not seeing consumer loan demand, we don't need that funding at that same rate. And so again, just we've seen a little bit more breathing room the last quarter or so as a result of that slowing down.
One other thing on the funding cost of my head jumps to like the funding source side of it, and it's money's fungible, right? I remember like back when I was at NCUA, and if I was lucky enough to get an award where they gave me an extra couple $1,000s for something that was really cool, that check would come in and it's, you know what, I'm going to buy a TV with that. And then you'd see, I'm going to buy, no, wait, I already spent that money, but the money's fungible. And one thing that always sticks a little bit with me when I'm thinking about the exam process and the regulatory process is every dollar is a borrowed fund, right? Your undivided earnings, you've borrowed from your members because you've decided to keep them and not disperse them. Your share certificates are from your members. Your share deposits are from your members. Money from the Federal Home Loan Bank is a borrowed product. Money from a purchased non-member CD. It's all one sort of borrowing. And NCUA sometimes, in my mind, over-relies a little bit on it's not a core deposit, and core deposits are stickier. And I get all that stickier, but there's definitely a regulatory, I don't know, obviously a share that's been there for 100 years is the best dollar, and the worst dollar is one of those other forms without naming one of them. Any thoughts about that whole concept and what's the best way for a credit union to look at those different options and different tools and different levers? Because obviously you need policies and procedures behind that, but every one of them can play a really good role in making your credit union as its strongest it can be.
Yeah, absolutely. It's the funding side's a fun conversation because you get so many different opinions. But obviously, I think on the core deposit side, we'd love for every institution to have an entire balance sheet full of savings accounts that cost 5 basis points. That would be phenomenal. And I'm sure every institution out there would love that as well. It's easier said than done. It's about meeting consumers where they're at. And I think whether it's a non-maturity deposit, a CD, a borrowing, or a non-member CD or what have you, they're all just, like you said, sources of funding that all have different dynamic structures and rates. And I think there's never a right or wrong answer. It's all about how it fits together as a part of the whole. I think there's definitely a case for borrowings from the FHLB and other areas like that, because it could be a very good strategic lever to pull. And I think one thing I try and tell institutions is, CD promos, I called them out a little bit ago. Sure, they may be more expensive. Maybe they're $3.90 right now in a rate, but there are a lot of participants in the financial industry that fund themselves at much higher rates than that. We're talking about our credit unions maybe their cost of funds is 150, 200 basis points. We're still borrowing at a cheaper rate than the US government right now. Yeah, that's still something we have to keep in mind. And it's not good or bad in isolation. We have to think about everything as part of a whole. And it's about assets and liabilities. How do they mix together? And what is the risk on the asset side compared to the risk on the liability side?
And along those lines, and I'm having a senior moment in my head, but the studies that credit unions need to do about their deposit stickiness, I'm forgetting what that study is called, but NCUA is asking for that. And during the last few years has asked for it because they want to make sure the assumptions are reasonable. They have their NEV test, which allows them to do a rough justice comparison. But I've seen some anecdotal situations where NCUA asked for that study to be redone, and the deposits are even more stickier than the credit union thought. It ends up almost. NCUA thought that the study would say, yeah, you're being too liberal in your assumptions, and the exact opposite was the fact. Have you seen that in any recent situations?
Absolutely. We run a number of those deposit studies, as you define, measuring how that decay and those outflows of deposit works. And in an ALM model, especially, it's designed to be highly conservative. So we've definitely seen that when we refresh the deposits, they're very sticky. And that's still probably being fairly conservative.
Right.
And in those types of studies, what we're often doing is we're building an assumption off of the individuals that are actually moving their money. So in an ALM model, it could be, again, 100% of your population is going to have assumptions that are driven by 5% of actual behavior. So the sample that we're using to explain or apply to the whole, it could be very small. And so that's whenever you run these analyses, you actually see, hey, we've got deposits here they've been around. You know, does that mean they're going to be there tomorrow? Maybe not. It's the historical data is only so good as it is. Credit unions being retail institutions, they have very sticky sources of funding. There's not as much concentration like you see in the commercial banking space.
It's like Silicon Valley Bank failing and the run that happened there and the eye-opening experience. Their uninsured deposit was through the roof compared to banks, and banks on average were 5 or 6 times more than the average of the biggest outlier in credit unions, which kind of speaks to that.
Exactly. So it's just again, a different funding base. And that's where, yeah, I'm the kind of person who says there's no such thing as risk if you price it. The hard part though is pricing it. And I think we can't take anything as in isolation. We just have to think through, okay, what is the actual exposure and how do we all fit these pieces together? Credit union, the banking industry, it's a very complex industry. Not only just from the regulatory side, but also just matching consumer behavior and all the risks that we're trying to evaluate simultaneously. It is a lot of work. It's tough, but we just got to think how it all fits together.
And along those lines, have there been changes in it? So having gone through all the stimulus that kept rates low and made us lose a little bit of focus about this whole side of it. And now we've got through it and people remembered and brought it back to a key focus. Were there any learning lessons from that, or did that trigger any new tools or new ways that you at ALM First are looking at helping your clients and credit unions?
Yeah, absolutely. I think definitely some learning experiences and gentle, not so gentle reminders about more how quickly things can move, especially with rate hikes. I think we could all say that, yeah, maybe we expected rates to increase, but not to the extent that they did. And kind of forgot that deposits can move quickly. I think that was one of the eye-opening things of deposits were changing at a rapid pace, maybe not necessarily again in the credit union industry, but across banking and credit unions, funds were leaving the institution fairly quickly for, again, the Fidelity money market funds at Schwab, et cetera, Treasury Direct. And the few things that we built since then, we worked to build more tools that our clients can use to assess their own risk. And so while we're an outsourced or in-source provider, we'd like to say, of ALM reporting, we know that institutions want more at their fingertips. And we recently launched what we call our liquidity on demand. So that's been launched within the last 9 months. So institutions can be stress testing their liquidity, okay, how can we survive various versions of apocalyptic liquidity scenarios, and have the ability to build in policy metrics and early warning indicators so we can see when do we go from feeling nervous to heartburn to nausea, if you will, and do that in real time. And then similar to that, building out just more tools like a more advanced interest rate risk on demand tool, just to give institutions more instantaneous access to the scenarios they need to run.
Are you yet tiptoeing into artificial intelligence side of that, or do you see that as something that's in the arc here moving forward? Any thoughts on that whole arena?
Yeah, absolutely. Yeah, I'm not admittedly the best in the AI and tech space. We definitely have our eyes on it. For me, AI, and it's really just been this evolution that years ago we called it machine learning, right? And this is really just the next evolution and advancement of that. And I'm not tuning to oversimplify. People that live and breathe in the tech world would probably throw something at me for saying that. But do see that this is an opportunity for advancement. Where we're trying to evaluate it is, can we use it to create better capital allocation decisions? Can we use it to measure risk more on a real-time basis and use that to advise institutions of, okay, we need to de-risk on the credit side. Or at some points, I think a number of institutions, it might be the opposite of, we need to take more risk. We're getting paid a lot to take on risk in this particular sector. Let's go do it. And so that's one thing we're evaluating, and not something I'm going to say we have ready to unveil to the world, just more on the
Right.
investigation stage.
Yeah.
Sure.
Yeah. Oh, that makes sense. The loan sale platform in a environment where consumer loans are drying up, there's probably some credit unions that have a unique field of membership or a unique situation in their city or state that might even have a little bit more demand. Are you seeing that spigot turn up or turn down recently?
Yeah, great question. I'd say the market's definitely changed within the last 12 months. I'd say a year ago or so, there wasn't as much demand to purchase loans. I think people were still trying to get used to how much cash they had on hand. The outflow of deposits we were all experiencing, I think it left some scars naturally. But this year, to start the year off, I'd say that has turned. There is more demand to purchase loans, and definitely seeing more appetite to fill loan buckets. And I don't, obviously, nothing wrong with that. I think things are pretty well priced right now. But again, my concern is more for credit unions that feel married to hitting a budget at the end of the year. Do we just add loans for the sake of adding loans, regardless of what the rate is? That's where we get a little nervous of maybe some discipline falling by the wayside. But
Sure.
right now, that's more me just crying out into the wilderness, if you will. But let's be cautious. I don't think it's anything to be concerned about today.
Just keep your eye on it.
Exactly.
Yeah.
Exactly.
Yeah. And then was there a pilot program that was recently approved by NCUA? You want to talk through that a little bit and what it is and how you see that progressing?
Yeah, absolutely. It's something we're really excited about, getting to advise on a loan fund for credit unions. So for federally chartered credit unions, they have fund or funds, if you will, with a max of 30 investors. And the goal and the reason we're really excited about it, and worked with the NCUA for a couple of years prior to it being the pilot program being launched, is that in this loan transaction world, in the participation world, there's some inefficiencies. And for, say, a large credit union that wants to sell and generate liquidity, some credit unions will go the securitization world, where we've advised on a number of those, or they'd go into the participation world. And maybe if they wanted to sell 300 million in auto loans, it would end up being 10 different credit unions that they'd have to piece it out to, or even more. And that just doesn't create a lot of efficiencies. It creates costs in many different forms. And so one benefit we see is just economies of scale of, we could have the fund that just purchases that 300 million. And then it's one buyer, and then the fund is responsible for parsing it out to the investor group. So really love it from that aspect where, again, we can create more efficiency in the industry. And then, again, because it can be a single large purchaser, really giving credit unions an opportunity to acquire assets or subsectors of assets that it'd be hard for them to get on their own. And so we think it really, again, is just a great thing for the industry on a number of different levels. And we're still building it out. We want to take things in a very methodical pace and make sure that we're not only dotting I's, crossing T's, and checking boxes, but that everything we do is going to be really in line with safety and soundness. And so we're really wanting to make sure that the fund's even rated, which isn't necessarily a requirement, but we think it's best for credit unions overall.
Yeah, that makes sense. And if I'm remembering right, the derivative program started as a pilot program. And I remember the reason I remember that is when I was at NCUA, I remember at some juncture, I thought, okay, pilot programs need to either end or they either wind out as this didn't work or they convert to a real program. In that instance, dipping the toe in the sandbox of the pilot program led to the agency saying, hey, yeah, if it's structured right and if it is safe and sound, there's an arena where this can mitigate the risk for the credit union and then therefore mitigate risk to the insurance fund and NCUA. So I think it's wise to put good guardrails around it, because for it to convert from a pilot to a real authority, NCUA needs to get their comfort around that as well. So I think that's a wise approach.
Yeah, absolutely. It's been fun talking with the institutions. We know there's a lot of excitement around the fund, and we're, again, very much looking forward to seeing how the pilot program plays out, and very excited to work with more credit unions and advancing it.
Got it. You mentioned mergers and the like. So with these other pressures that we've seen, what are you seeing in that arena? Or is there an uptick? Are you seeing more large credit unions contemplating it? Are you seeing mergers of equals discussions more? Any thoughts on that topic?
Yeah, absolutely. Definitely seeing more mergers out there, and more mergers of equals that are at larger asset sizes. A number of hit the newswire as of late that I think just spurred the conversation, regardless of asset size, of, oh, do we need to merge? Do we need to grow? And I'm not on the merger side of this, of the company, so I won't speak for them. I think it's all about, to me, what is the institution's goal? What is the board's goal? And how do you see that goal in perpetuity? So there's definitely different reasons to merge. Maybe it's just to get economies of scale. Maybe it's succession planning. But I also think there's, for those institutions that are kind of on the fence, not sure if it's the right move or not, I think there's a place for actual community institutions as well. Institutions that are really focused on serving the community, serving their members, and being part of a growing, thriving, again, community. I think that's still viable. We just have to make sure we structure it correctly, and that we're thinking of all the possible pros and cons.
Yeah, that makes good sense. Is there any initiative or any hot topic that I should have asked you about here, Thomas, that I didn't?
Great question. I think we really hit on the high points of what we're focused on. I'd say one other thing that we didn't touch on, which I think is something that's important for credit unions, is just the consistent focus on talent management. One of the challenges I think that sets credit unions apart from banking counterparts is the ability to lock in your high level talent for a period of time. Banks have equity at their fingertips, where there's some way of developing deferred compensation plans that are a little bit easier to structure. Credit unions don't have that. And when looking at how do we overcome that type of challenge, we've really focused on advancing and building out employee benefit pre-fund portfolio management, as well as executive benefit teams, because it's something that's not going away, at least as we see the industry today. And I think it's important because to keep quality employees in the credit union right now, effectively institutions have to pay, oversimplifying, it's cash compensation, cash bonus, and that's expensive. So that's another thing that we've been working at for a number of years now, and really excited to keep pushing that forward. Again, I think it's best for the industry, and we'll keep plugging away at it.
Yeah, building those leaders is expensive, and keeping them might seem expensive, but if you don't keep them, replacing them is even more expensive and can have other collateral
Exactly.
challenges. So no doubt. I'm glad you brought that up. This has been a lot of fun talking through where you guys are at, where we think the industry's at. If one of my listeners or watchers want to touch base with you, Thomas, what's the best way for them to reach out to ALM First or to you directly?
Yeah, absolutely. Feel free to reach out. My email is tgriswold@almfirst.com. That's TGRISWOLD at ALM First. And you can also reach out to our company directly. Go to our website, www.almfirst.com, or info@almfirst. All of those are perfectly accessible. We love helping institutions however we can. Our mantra is really, we want to help institutions solve problems. Love talking about whatever we can do to help.
Very good. Appreciate your time today, Thomas.
Absolutely. Thanks, Mark. Really appreciate it.
You got it. And listeners, watchers, I want to thank you for listening again. I hope you'll listen again soon. Mark Treichel signing off with flying colors.